Welcome to this explainer. Today, we're diving straight into a massive proposed shift in the retail trading space. We're going to unpack the QuantGate B2B brokerage slide deck and figure out exactly how they plan to transform standard, high-churn retail platforms into true institutional-grade asset management hubs. It's a fascinating pivot, so let's get into it.
Here is our roadmap for today. We'll start with number 1, the retail brokerage illusion. Then move to 2, enter the systematic swarm. After that is 3, eliminating churn and securing moats, followed by 4, the co-investment economics, and finally, number 5, that $11.5 million financial projection.
All right, starting off with Section 1, the retail brokerage illusion. Let's break down the stark contrast between illusion and reality in the retail brokerage world. You know the illusion, right? It's what you see plastered all over legacy copy trading leaderboards. You've got these lucky, over-leveraged gamblers hitting the absolute top spots simply because the systems rank them by highest overall return. But the hidden reality underneath all that, it's grim. We're talking severe server bottlenecks, massive slippage, and bleeding customer acquisition costs that just eat away at the broker's bottom line.
This completely nails the core problem we're talking about. Up top, you see the illusion. It's this beautiful, smooth upward curve that practically guarantees a retail trader gets ranked number 1. But look underneath. That exposes the harsh reality. What you're actually looking at is a series of massive, unrealized drawdowns. Sometimes completely blowing past 900%. The trader is basically just holding on to these deep losing positions solely to avoid realizing a loss, which, of course, artificially inflates their win rate. And the business impact? The broker's lifetime value of that client is completely destroyed way before that client ever generates any meaningful, sustainable spread revenue.
So what does this actually mean in practice? Well, it creates this absolutely brutal 90-day churn cycle. Essentially, 90% of users just blow up their accounts and churn out within 90 days. This traps the broker on this never-ending treadmill of customer acquisition, completely wiping out traders long before they can actually become profitable assets for the firm.
Which brings us to Section 2. Enter the systematic swarm.
Okay, before we get into the actual architecture, we need to clearly define what QuantGate actually means by a multi-node swarm. Forget the idea of one single robot just taking a massive gamble. A swarm is a collection of 12 to 20 distinct, highly profitable, totally non-correlated trading robots, and they're all working perfectly in unison. They're executing mathematically appropriate lot sizes, which is huge because it ensures continuous, high-frequency execution while keeping those drawdowns remarkably low.
This right here represents the end of the single point of failure. You've got a central master node orchestrating this incredibly complex web of independent execution nodes, 12 of them in this specific case. And because these nodes are non-correlated across different asset classes, they systematically absorb the risk. Think of it like this. If one node hits some turbulence, the others are there to flatten the variance. This keeps the entire portfolio on a smooth, unbroken upward trajectory. It's actually a really elegant solution.
And as you scale this architecture up, it builds out into a seriously impressive algorithmic taxonomy. Just look at Tier 1. They call these the 100% snipers. We're talking about strategies with flawless execution that just sit and wait for the absolute perfect mean reversion setups. Then you've got Tier 2, the high consistency sector. These are hitting 90 to 99% win rates and act as the real endurance and momentum engine. And crucially, Tier 3, the Genesis boundary, is completely locked. It's proprietary. This ensures that the core volume-driving anchors remain completely exclusive to the enterprise platform itself.
Let's move right along to Section 3, eliminating churn, securing moats.
Everything we just talked about is driven by a deeply integrated dual-force mechanism. On one side, you have the revenue engine. This uses those segregated swarms we mentioned to practically guarantee compound spread commissions while keeping account drawdowns to an absolute minimum. It literally eliminates that retail blow-up cycle we talked about earlier. And on the flip side, you have enterprise protection. This uses whitelisted, hard-coded server locks to protect the scarcity of the algorithms. Basically, it makes sure there is no way anyone can rip this intellectual property and just run it on a competitor's server. This setup powers what the source date calls the VIP strategy architect flywheel. And honestly, it is a brilliant 3-step mechanism. Step 1. Your elite high-net-worth VIP clients get access to build custom 5-bot portfolios right in a safe sandbox environment. Step 2. Once things are stabilized, those VIPs deploy their mathematically sound portfolios back onto the broker's public leaderboard as master traders. Then, step 3, thousands of standard retail followers naturally copy these highly reliable VIP portfolios. This creates a massive wave of retail amplification, driving explosive spread and volume across the broker's entire network.
Now for the really interesting part, Section 4, the co-investment economics.
The whole financial architecture here is built on top of one very specific number. We're talking about a firm, $20,000 monthly B2B enterprise integration fee. Paying that fee unlocks the entire whitelisted ecosystem, and it gives the broker a 50-seat VIP block that they can distribute directly to their top-tier clients.
And this shows exactly how all those incentives align through a mathematically guaranteed co-investment. Quadgate takes that fee, and they actually put $5,000 of their own seed capital directly onto the broker's servers. But the real magic? It's in the split. The broker captures 0% of QuantGate's master trade profits, sure, but they capture 100% of the net spread from the explosive follower volume that those master accounts generate. It's a wildly efficient dynamic.
Plus, by taking those 50 VIP seats, which are basically just cryptographic activation codes, and handing them out to the broker's dormant, high-net-worth clients, they unlock something huge. They instantly activate $500,000 in active copying assets under management. And because these are existing, albeit dormant clients, this massive influx of volume happens with absolutely zero marketing burn. Literally zero new customer acquisition cost. It's a completely tapped-in resource just waiting to be activated.
All right, let's look at the payoff in Section 5, the $11.5 million financial projection.
When you synthesize the tech and the math, it leads us directly to this definitive projection. By leveraging 7 years of live execution history and taking on exactly zero R&D risk, the broker can completely transform their user base. Just by swapping out a high-churn base for long-term algorithmic followers, the data projects a staggering $11.5 million in unrealized net new spread revenue for the broker over a 12-month period. That is a massive shift.
The data here is crystal clear when it comes to the hidden costs of the retail illusion, which leaves decision-makers looking at this explainer with a pretty critical and honestly provocative question about the future survival of their operations. Will you continue managing a high-churn casino, or are you going to take the steps to architect a truly dominant institutional moat? It's something you definitely have to think about. Thank you so much for joining me for this explainer. I hope you found it as fascinating as I did.